Let's get across the market open now. Kyle Ryder joining us from Capital.com. Kyle, happy Monday to you. All right, let's first start in the US on Friday. Those jobs numbers weaker than expected, reinforcing the likelihood of a rate cut later this month.
Yes, and if you look at the implied probabilities, the potential of a 50 basis point cut too, although it's only marginal, based on the CME Fed Watch tool, it's giving it sort of a 10% implied probability that we get a jumbo cut. But more or less, that 25 basis points is baked in. The markets are sort of flirting with the idea now that there's a 60% chance of 75 basis points before the end of the year, which is effectively the equivalent of a cut at every decision or every meeting between now and the end of the year. And the direction of travel is fairly clear, that the labour market is weakening, that perhaps it's even weaker than what we're seeing in just the official data itself. And that's because of the revisions that we keep getting through month over month now, coupled with the data that we got last week that job vacancies are higher than expected, jobless claims are picking up. That ADP private payrolls release, which is being looked at much more closely now as having some sort of predictive value of where the officials' data happens to fall after revisions, all suggests that the US labour market is in a fairly precarious position. Lo and behold, I mean, obviously we got a weaker US dollar off the basis of that data release, but equities are holding up reasonably well, mostly by virtue of some strength in tech. Really, as yields drop, and it would appear markets feel reasonably confident that with sufficient easing, the Fed can get back on top of things and keep the economy on an even keel. But it sets us up for a precarious position because, again, the US dollar's down, gold's up as a result as well. But stocks are still at that kind of level that would suggest that we're not going to see a kind of hard landing out of all of this. And therein lies the problem that if we do see a continued deterioration in labour market conditions and this sense that the Fed is a little bit behind the curve, maybe a very richly valued market will have to start discounting an impact to earnings in the future from a weaker US economy.
So we do get inflation data later this week too in the US. What is the expectation there? And of course, there's a lot of debate going on with those Fed members at the moment as well.
Yeah, well, we're in the blackout period now, pre-FOMC, so we'll get a nice little quiet when it comes to that debate for the next week and a half or so. The inflation data or the CPI data, obviously not being the Fed's chosen inflation gauge, but still a small hurdle to leap over before we can get to that decision. It's going to show more than likely a little bit of a pickup in inflation. We're still seeing prices in the States sort of anchored around 3%, and there's a strong argument to make that even prior to the tariffs starting to filter through the US economy and all these other issues, predominantly on the supply side, keeping inflation elevated or even sort of rising as that kind of one-off change to the price level starts to come through, the prices were already really sticky and maybe re-anchored above the Fed's target. Nevertheless, the markets are sort of willing to tolerate a little bit of a pickup in inflation, which is expected to come through. To be fair, the month-on-month figure is supposed to be about 0.3%, which is down from the 0.9 that we got a month earlier, so that will probably be something of a relief. But the clear risk here is that we see data that shows an upside surprise that suggests that the Fed doesn't have as much wiggle room as it previously thought, noting that they have forecast a pickup in inflation before the end of the year and still implied that it was willing to cut rates through that. If that pickup in inflation is bigger than expected and the Fed has less wiggle room, that could be a bit of a problem, because then it raises this issue of the Fed not being able to, say, do a 50 basis point cut in a few weeks' time, or lower by 75 basis points or so by the end of the year to absorb this kind of slowdown in the labour market. So the PCE data gave the Fed the green light. I suspect it means that September is going to result in a cut no matter what. But if we get, again, a spicy inflation print, that October and that December meeting might be called into question. And once again, that kind of stagflationary light dynamic that everyone is fearing could bubble a little bit closer to the surface and cause a bit of volatility.
Meanwhile, in Europe, the ECB making its decision this week. What's expected?
Nothing, basically. It looks like it's going to be a nothing burger. And the ECB seems to be wanting to play a very kind of wait and see, small target policy. Over the last couple of meetings in particular, and the last meeting that we did get was a very neutral tone. The language is effectively that they needed to gauge where tariffs would eventually end up, knowing that before the last meeting that we got from the ECB was before we got that sort of 15% tariff rate applied on the Eurozone by the United States. And there's also the sense that, they are looking to wait to see how the impact of prior easing, about 200 basis points worth of cuts in the prior year and a bit or so, is filtering through the European economy. So their view is effectively that rates are neutral now. They are communicating that they feel that they're in a comfortable position to be able to sort of wait and see for a little while. So that means that this meeting is probably going to be a little boring when it comes to policy itself, but there will be that guidance. They'll be able to talk a little bit more with a little more confidence about the potential impact of trade policy on the Eurozone economy. And of course, we've got all these sort of other dynamics going on in, say, energy markets, which are significant to Europe as well as this broader global growth slowdown that maybe will shift the language a little bit one way or another for the ECB. But otherwise, it's probably the biggest, if not, sort of second to CPI biggest event of the week. But in saying that, it doesn't seem like it's going to really rattle the cage, particularly much given, again, the ECB's desire to sort of wait and see.
And Kyle, there's a watch on Japan at the moment. Political turmoil there with the Prime Minister resigning. This was building last week, that instability, seeing a sell-off in the yen and also those 30-year bonds hitting record highs.
Yeah, and we've already seen a bit of weakness coming through the yen this morning. It'll be interesting to see if that manifests in a stronger Nikkei or a weaker Nikkei, really on the basis that obviously a weaker yen should in principle boost that index because it's sort of negatively correlated. But the flip side of that is that there is this kind of legislative uncertainty in Japan now, political uncertainty in Japan now. For markets, the really critical detail is this, that after the last election, which obviously the LDP failed to gain a majority, there is a sense that some difficult fiscal reforms were going to be challenging enough to pass through. Maybe there would even be some degree of fiscal easing in Japan, and that would potentially add to upside risks to inflation that the Bank of Japan has subsequently delivered a very kind of neutral tone towards trying to address. The fear is that this could elicit even I should say will result in sort of a stagnation when it comes to difficult fiscal policy to try and take some of the heat out of the Japanese economy, and the inflation that is picking up once again away from target by some measures is sort of close to 3% or thereabouts, and that without a Bank of Japan becoming much more hawkish and taking much more seriously its fight against inflation, there will be much more negative real yields. There will be a yen that subsequently depreciates. There will be fears about the back end rising even further in Japan, especially as marginally bond supply increases because of a lack of quantitative easing and additional issuance and everything like that. They kind of mix it. We're also seeing other parts of the world where bonds and currency sells off simultaneously because of fears of unsustainable fiscal policy, as well as inflation being unanchored and moving a little bit out of control. So that this morning, that's kind of the initial market response. Again, the Nikkei should be the interesting one to watch to see whether it responds favorably or not to that dynamic. But for now, it's one that's kind of causing a little bit of uncertainty in global markets or in Japan. And there is that potential fear that if we see this, resulting in a run-up in the long end again, that'll put upward pressure in global bond yields and maybe cause a little bit of a squeeze on equity valuations.